Welcome back to Investing Talk podcast.
Today, we're looking at SLV, the iShares Silver Trust.
Usually when you bring a commodity to the table, I mentally prepare myself for a nap.
Right.
I brace myself for this very dry, dusty conversation about hedging inflation or burying bars in the backyard. But the performance numbers for 2025, this feels different.
It is different. Fundamentally different.
This doesn't look like a safety trade. It looks like a high-growth tech stock on steroids.
We have to start with that headline number because it is honestly staggering.
Yeah.
If you held SLV in 2025, you didn't just beat the market, you obliterated it.
Okay, what are we talking about?
SLV delivered a 147.86% total return in 2025 alone.
That is massive. That's not normal for a rock. I mean, you're usually happy if a metal just keeps pace with inflation.
Exactly. It's huge. It significantly outperformed gold, crushed the broader S&P 500, and it left most of the, Magnificent Seven tech darlings in the dust.
So if you had this last year, you're very happy right now.
Very, very happy. It's the breakout star of the portfolio.
Right, but that's the rearview mirror. We're sitting here mid-January 2026, and SLV is trading around what? $84.56?
All-time highs.
Hitting all-time highs. So the skeptic in me has to ask, is this just a rock that got expensive because of hype? Is this a bubble?
And that's the question.
Bubble just waiting to pop? Or is there a real fundamental shift happening here? Because buying at the top of a parabolic chart, that usually hurts.
That's exactly what we're going to unpack. The research we've looked at suggests this isn't just speculation or some meme trade. We're looking at whether this is a bubble or a permanent repricing of a critical asset that the world is quite literally running out of.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us keep the lights on and keep digging into these charts for you.
Let's get into it.
All right, let's strip this down to the studs. What exactly are we buying here? Because SLV isn't a company.
Right.
There's no CEO giving guidance calls. There's no sales team, no R&D department inventing, new ways to be shiny.
No, exactly. SLV is a commodity trust. When you buy a share, you're not buying a business. You're buying a fractional interest in physical silver bullion held in a vault.
So talking about revenue or PE ratios, that's kind of pointless here.
Completely pointless. There are no earnings. The earnings for an investor are purely the appreciation of the asset. Silver goes up, SLV goes up.
Simple as that.
It's a direct proxy. You're betting on the metal itself, not a management team.
And just to be clear on the scale, what's the actual backing here? Is there real metal sitting somewhere?
Oh, it's massive, and it's physical. As of January 16th, 2026, the net assets are approximately $46.91 billion.
$47 billion. In silver, that's a lot of metal.
Yes, stored in secure vaults.
Yeah.
Mostly in London. And from a financial health perspective, it's pristine. There's no debt, no leverage. It's 100% backed by the physical metal.
Which is comforting. You don't have to worry about a CEO, cooking the books. But let's get to the demand side. Why did silver go up 147% last year? Grandma's silverware didn't become that popular overnight.
This is where the story shifts. It goes from precious metal to industrial necessity.
Okay.
The driver isn't jewelry. It's the green energy transition and tech infrastructure.
Yeah.
You have to understand the chemistry. Silver is the most conductive metal on Earth for electricity and for heat.
So we're talking solar.
Solar is a huge part of it. But here's the nuance most people miss, and this is crucial for 2026. It's not just that we're building more solar panels, it's that the technology of the panels is changing.
How so?
In 2025, the industry shifted heavily toward what they call N-type or top econ cells.
Top econ cells, that sounds like a military operation.
It stands for tunnel oxide passivated contact. You don't need to know the engineering, but you do need to know this. These high-efficiency panels require significantly more silver paste per unit than the old ones. We're talking 20 to 50% more silver per watt. So as the world sprinted to build out solar in 2025, they didn't just buy more silver, they bought more silver per panel. They drained the supply.
That's a multiplier effect. Volume growth plus intensity growth. And you also mentioned connectivity.
5G technology. The components inside 5G towers, the devices in your pocket, the antenna, the filters, they all require silver for that same superior conductivity. You can't have high-speed, low-latency data without it.
So you have two massive secular trends.
Energy and connectivity.
Fighting over a finite supply of metal. And that leads to the supply constraint argument. Is silver actually hard to get?
It's uniquely hard to get. Here's the insight on mining that explains this squeeze. Most silver isn't mined on purpose. About 70% of it comes as a byproduct of mining for copper, lead, or zinc.
Wait, so miners aren't even looking for it? It's just the icing on the cake?
Exactly. They're digging for copper. They happen to find some silver. This means supply is inelastic. Even if the price of silver goes to $100, a copper miner won't double production just to get the byproduct.
So demand is exploding from solar and 5G, but supply is structurally stuck.
It's a classic recipe for a price squeeze.
Okay, the macro backdrop makes sense. But why SLV? Why not just go buy silver coins and put them in a safe?
Well, think about the logistics of storing even $50,000 worth. It's heavy, it takes up space, you need insurance.
Okay, for me, it's more like a shoebox, but I get your point for serious capital.
The competitive moat for SLV is really scale and liquidity. It's the largest silver ETF. You can get in and out instantly at the spot price.
Versus the premiums you pay at a coin shop.
Right. You might pay a 20% premium over spot just for the fabrication and the dealer markup. With SLV, you're getting pure exposure with very low friction.
Plus, the trust aspect helps with counterparty risk.
Correct. Unlike derivatives, where you're betting on a paper contract with a bank, SLV holds the metal. If the bank fails, the metal is still in the vault.
I have to push back on one thing, though. You are paying an expense ratio. You're basically paying a fee to have someone watch a pile of metal.
You do. It's about 0.5% a year. But you have to weigh that against the cost of a safe, insurance, and the liquidity premium. You're paying for the convenience of treating silver like a stock. Click a button and sell it on your goon.
Fair point. Liquidity is king. All right, the story sounds shiny, but let's pivot to the charts to see if the math holds up. A good story doesn't always mean a good entry point.
Agreed. But in this case, the charts are, well, they're screaming strength.
We're at 84.56, a massive breakout.
It is. ChartMill has assigned this a 10 out of 10 technical rating. We're in what technicians call a blue sky breakout.
Blue sky, meaning there's no overhead resistance.
Exactly. Imagine a rocket clearing the atmosphere. There's no ceiling left from history where people are waiting to sell just to break even.
The bag holders.
Exactly. In a blue sky breakout, there are no bag holders. Everybody who owns it is in profit. That psychology lets the price run much further than people expect.
What about the trend lines?
Classic higher highs and higher lows. It's trading well above all its key moving averages. The 50-day, the 200-day, it's surfing the wave perfectly.
And momentum.
The 3-month MACD just signaled another buy. Momentum isn't slowing down, it's accelerating.
Okay, but trees don't grow to the sky. Where are analysts seeing this go? What are the targets?
The projections are getting aggressive. Analysts are projecting near-term upside of another 33 to 61%.
Wait, another 60% on top of the 147?
Yes, they're targeting $100 to $120 per ounce in this cycle.
$120 silver. That sounds insane considering we were in the 20s and 30s in 2024.
It does, but remember, silver is volatile. When it moves fast. The difference this time is that industrial floor we talked about.
Okay, let's look at the downside. If this pulls back, where's the safety net?
We're looking at support zones around $60 to $62. That was a previous consolidation area. If we get a correction, that's where buyers should step back in.
So a floor around 60, ceiling above 100. Decent risk reward, technically.
It's compelling.
The chart looks like a rocket, but let's see what the big money is actually doing with their capital. Retail chases charts, but institutions set the trend.
And this is where it gets fascinating. The whale activity here is, it's undeniable.
Walk us through the options flow.
We're seeing a massive surge in open interest. We're talking over 9.9 to 10.2 million contracts open.
Put that in context for us. Is that normal?
It's roughly 113% above the 30-day average. This isn't a little bump. It's a flood of new capital entering the derivatives market.
And are they betting up or down?
Up, heavily. 64 to 69% of the volume is in call options.
So for every bear betting on a crash, there are 2 bulls betting on a rally.
Exactly. But it's not just the volume, it's what they're buying.
I'm looking at the tape here. These unusual trades are interesting. I see large block trades at the $75 strike. But look at the expiration, January 2027.
That's the key.
And here's another huge block, $65 strike calls, expiring March 2026.
This tells us something very important. These investors aren't day trading, they're positioning for a multi-year bull run.
These are leap years.
Exactly. They expect the price to be significantly higher in 2026 and 2027. They're paying a premium to lock in their position now.
That January 2027 expiration is a confident bet. That's millions of dollars on the line saying this trend is durable.
It's not speculation, it's conviction.
What about the general sentiment, the headlines?
Alpha Vantage sentiment score is flashing bullish. The headlines are starting to call this 2026's hottest trade.
Oh boy, hottest trade. That usually triggers my contrarian alarm.
It does bring up the FOMO factor, fear of missing out.
It looks like cluster buying to me. Institutions are piling in together.
And usually, the trend is your friend when that much money is pushing in one direction.
Usually. Until it isn't. Okay, everyone is bullish, which makes me nervous. Let's dig into the risks. What kills this trade? Silver is known as the devil's metal for a reason.
It absolutely is.
Mm-hmm.
And we have to talk about volatility.
What's the beta on SLV?
The beta is 1.44.
Okay, let's decode that. It moves 44% more than the stock market.
Right. If the S&P drops 1%, silver might drop 1.4% or more. Goldman Sachs actually issued a warning. They flagged extreme price moves due to tight liquidity.
So a 20 or 30% correction wouldn't break the thesis.
Now, in the silver market, a 30% drop is just a Tuesday. It's normal, but it can shake you out of your position. The RSI is technically overbought right now, too.
So we're due for a breather. The engine is running hot.
We're definitely stretched. You need the stomach for the swings.
What about the macro side, the Fed?
This is risk number 2. The whole bull case relies heavily on rate cuts.
Because silver yields 0.
Exactly. When interest rates are high, holding silver has a high opportunity cost. You'd rather be in bonds. The thesis assumes the dollar weakens and rates come down.
So the threat is, if inflation spikes again, and the Fed has to hike or hold high for longer.
Then silver becomes much less attractive. It could cause a rapid repricing downward.
And what about the industrial side? What happens if we hit a global recession?
That's risk number 3. If we get a global recession, factories shut down. They stop making solar panels. They stop rolling out 5G.
So demand drops.
Precisely. Unlike gold, which is a pure safe haven, silver needs a healthy economy to really boom. It has an identity crisis during recessions.
And finally, just simple profit taking.
It's huge. After a 147% run, a lot of people are sitting on massive gains. At some point, they might just want to cash out.
High risk, massive reward. Let's wrap this up with a score. Where do you land on SLV?
I am extremely bullish. I'm giving this a 9 out of 10.
9 out of 10. That's one of your highest scores lately.
It is. Look, SLV is the premier play for 2026. The combination of industrial demand, specifically that shift to N-type solar, colliding with physical supply tightness, creates a structural floor. Then you add the dovish Fed policy. It's a perfect storm.
And the technicals confirm it.
The technicals are 10 out of 10. And the institutional options flow, those massive call bets for 2026 and 2027, confirms smart money sees the move to 100 plus as highly probable.
All right. I am slightly more cautious just because of the hottest trade hype, but I can't argue with the supply constraint. I'm going to give it an 8.5 out of 10.
Reluctantly.
Reluctantly. But based on the momentum and the fact that we are literally running out of silver, it is a buy, but I would size the position carefully.
Because of the volatility.
Exactly. Don't put your rent money in this and use those pullbacks. If it drops to 60 or 62, that's your entry point. Don't chase it at the absolute peak.
I agree with that. Patience is key.
So what's the time horizon here?
Primary is a multi-year hold. You want to ride this into the 2027 macro cycle.
And for the traders.
Secondary is a 3 to 6 month swing trade into the Q1 2026 demand cycle.
So hold for the big move or trade the Q1 pop.
Exactly. That's the case for SLV.
It's going to be a wild ride to $100, that's for sure. It forces you to think. If silver really is the oil of the new economy, what happens to the price when the first major tech company announces they can't get enough of it to build their products?
That would be the tipping point.
If you want to track the run to $100 with us, make sure to subscribe, like, and comment below. We'll see you in the next one.